Gold hit its highest level since February this week, fueled by a combination of central bank stimulus measures in Europe and the expectation of more to come in the US. On Thursday, gold climbed above $1,700 for the first time in 6 months, as markets waited to hear details of the European Central Bank's bond market intervention plan. Then on Friday, gold shot higher following the publication of disappointing US non-farm jobs data. Friday afternoon's London gold fix was $1,728, a gain of 4.8% on the week and the biggest weekly gain since last October. Silver also had a good week, with Friday's silver fix coming in at $32.22, a 5.6% weekly gain. Friday's official non-farm payrolls report showed 96,000 private sector jobs were added to the US economy last month, significantly less than many analysts were expecting. The figures for jobs added in July and June, meanwhile, were revised lower. The one bright spot was a fall in the unemployment rate from 8.3% to 8.1%, but this is unlikely to dampen the spirits of those hoping for more quantitative easing from the Federal Reserve. In today's world, the worse the economic news is, the happier the markets seem to be, since bad news raises the likelihood of more QE. The ECB, meanwhile, has unveiled its big plan to save the euro. It is called OMT, which stands for Outright Monetary Transactions, and will involve the ECB buying the government bonds of distressed nations, targeting debt of up to 3 years in maturity. To qualify for OMT support, a government must have asked for a bailout or entered into a similar precautionary programme. It must also fulfil its commitments under that programme, such as deficit reduction, or else the ECB could terminate support or even sell that country's bonds. This conditionality is clearly aimed at appeasing Eurozone members such as Germany, who are aghast at the idea of a central bank financing government deficits. Draghi added that OMT interventions will be fully sterilised, a way of avoiding accusations that the move is inflationary. In other words, the ECB will sterilise its bond purchases by selling other securities at the same time to mop up the additional liquidity. This is unlikely to appease the Germans, however, especially as it raises the prospect that the ECB might sell German bonds, which would have the added effect of further reducing the difference between Germany's borrowing costs and everybody else's. Only one member of the ECB Governing Council voted against the OMT plan, Jens Weidmann of Germany's Bundesbank. Following the ECB announcement, the Bundesbank issued a statement in which it said Weidmann regards ECB bond buying as being tantamount to financing government deficits by printing banknotes. But Weidmann is isolated. Under Draghi, the ECB looks set to intervene more aggressively than ever in the bond markets. As it does, its policymakers will acquire an influence over national governments' fiscal policies that many will regard as inappropriate for unelected officials. Next week sees the latest policy announcement from the Federal Reserve, as well as inflation data from the US and Eurozone and a volley of statistics from China, one of the world's big two gold-buying nations. To keep up with the latest in gold and silver, visit goldnews.bullionvault.com.